In this presentation, we will introduce the topic of capital budgeting. First, we'll start off with a definition, analyzing long-term investments to decide which assets to acquire and or sell. The term capital budgeting can be a little bit confusing to accounting students, partly because of the idea or the term of capital. We've used the term capital in a few different ways. You might consider the raising of capital. A company might try to raise capital. In this format, we're using the capital as an investment. So we're going to invest in something. Capital investments, typically long-term investments. The common scenario being some type of equipment or some type of asset that we're going to be using for the operation of the business, and therefore will be helping us to generate revenue in the future. So our typical scenario then being, should we purchase this piece of equipment or should we invest in this particular asset, which is going to help us in our operations in the future and therefore increase cash flows in the future? Because these are long-term decisions, they often take into consideration or should take into consideration time value of money. We can use these same decision-making tools in some of our personal decisions as well when we're considering decisions that will affect long periods into the future, and consider the time value of money and decision-making skills that we're going to use in capital budgeting as well. When we consider the process that a capital budget type of decision will take, it will usually start off with a proposal. So we'll have a proposal for a piece of equipment that we may need that will increase production. Once we have the proposal, then the capital budget committee will evaluate it. We'll typically say, all right, we have this proposal, let's evaluate it. Let's put a committee together to evaluate this proposal. The committee, of course, is run by management being employees, agents of the company. Because this is a large decision, however, we also want to go to the board of directors. So remember, the board of directors are the people that are actually approved or voted on by the shareholders. So within a large organization, we have the shareholders vote for the board of directors. The board of directors generally hires management. Management makes those day-to-day type of decision-making processes, runs the business. When we have a large type of investment, then management is going to make the decision, say whether we should do this or not. But because if it's a large investment, we'll also go to the board of directors, who are representing the stockholders directly, and then make the proposal there to have approval for any of these large capital investments. Again, the reason for that is because they're large, they're big dollar amounts, they're important, therefore they're going to be needing the approval process also typically from the board of directors. Capital budgeting decisions will require more time, more analysis to make. And there's a few different reasons for this. One reason is, of course, that a capital budgeting decision, the decision to purchase a large piece of equipment or make a large investment, is not a decision that happens all the time. And therefore, there's no formal process then for us to make the decisions. In other words, many times, many types of decisions we make on a day-to-day process are either things that we can go directly to the system and say, how am I supposed to do this in accordance with the rules? So we're just going to follow a set of steps in order to decide whether or not we should do this process or that process, make the decision based on policy, or we're going to make a decision based on our instincts. Many times, many of the decisions we make through our day-to-day lives are made more on instincts. We don't go through a formal process to make the decision. We kind of take shortcuts in order to make that decision. When we do the larger scale projects, things that are going to help or affect many years into the future, then we typically want to do more analysis, more long-term decisions. One of the reasons is it's going to help us to avoid some of the fallacies that can happen when we have longer-term decisions. We're not as good. Our intuition are not as good. Our shortcuts are not as good as we apply them to more long-term decisions. The outcome of a long-term decision is often not clear. So when we look out into the future, of course, we don't know what's going to happen. We don't know what's happening in the economy. We don't know what's going to happen anywhere. So what we're going to do is we're going to make our best projection, and that projection is unclear. Therefore, we want to make a little bit more time to think about, what the outcome will be so we can make our best guess. There typically are also large dollar amounts involved. So whenever we're considering the large dollar amounts, of course, we want to put more time into the decision-making process because it has a more significant effect on our operations. There's often going to be a long-term commitment. So if we're purchasing a large piece of equipment, or if we're making a large investment, then typically we're doing so because we expect return on it for a long period of time. And anytime there's going to be this long period of return, we really want to make sure that that investment is done well, because again, whenever there's a long period of time, our short-term decision-making processes, the usual decision-making processes we make, can falter, and therefore we want to have a formal decision-making process for those long-term decisions. It's going to be difficult to reverse many of the capital investments. So for example, if we purchase a piece of equipment or something like that, we can't just say that now we're going to reverse that at some point in the future. Once we make this long-term investment, this investment that may affect many years out into the future, we can't just stop it. Now, there might be a point in the future where we say this is no longer profitable to us. We made a bad decision. We're going to have to cut our losses and start from here. We're not going to let the sunk cost effect make us continue, even though the decision was not a good decision to make. However, we can't reverse the large investment that we made, and therefore it's best for us to think about these decisions and go forward. And note, as we consider different managerial accounting types of decisions, there are some decisions where trial and error is the best thing to do. We go at it and we say, we're going to do our best. We're just going to keep on doing. We're going to fix things up and we're going to work with it. And every time we make an error, we'll fix it. No big deal. And we'll just learn from all our mistakes until we get the process down perfectly. When it comes to long-term decisions that are going to be one-term decisions that are going to affect a long-term into the future, we can't do that. That's when you have to take the standpoint and say, okay, I'm going to measure twice, cut once here, as they would say in carpentry or something like that. We can't keep on cutting the piece of wood to see if it fits the door frame. If we cut too much, then it's not going to fit, right? So in this kind of scenario, we can't do the trial and error type method. What we have to do is make our best guess, do the proper analysis, go through the formal steps, and then put it in place correctly the first time. So when we make these decisions, we got to note that there's a time and place for both kind of methods, kind of shooting at the target and seeing what happens and adjusting. And then under this kind of decision-making process, we gotta really kind of think about it, measure first, and take our best aim, take our best shot, because that one shot's basically all we have. Although the details of capital budgeting decisions will vary a great deal, will differ from company to company, and they'll be different every time we have a new one, they will typically follow a similar pattern that we can then get used to and expect with a capital budgeting decisions. For example, the first thing that's going to happen usually is there's going to be some type of cash outflow with the expectation that we will then have some type of cash inflow as a result. So the typical type of scenario is that we're going to have to pay cash to pick up something, possibly a piece of equipment, that is then going to help us to generate cash in the future. And then at the end of that time period, if we're talking about something like a piece of equipment, we may sell that piece of equipment and we could have some cash flow at the end. And so our question then, of course, is, okay, we have to have this initial outlay for something like this piece of equipment. That piece of equipment then will help us to generate revenue over a certain time period. And then at the end of that time period, possibly we can sell that piece of equipment or at least scrap it and get some type of return after we're done using the equipment. Given those cash flows, given the initial outlay at the beginning and the cash flows that we will be receiving in future time periods, is this a good project to take on? Again, difficult for us to know that because our normal thinking process is really short term when we rely on our intuition, our normal heuristics in terms of how we make decisions. So when we have this longer term decision that pays off at the end, then we don't really judge those well unless we go through a formal type of analysis. The question then being, is it worthwhile for us to make the initial investment in order to receive a return in later years? The other complicating factor is, of course, that the money, the dollar that we're using, changes in value. It's not like a ruler. The ruler stays the same size every time we measure something. Dollars don't. Purchasing power of dollar changes. That's one thing we have to take into consideration, as well as all the basically uncertainty that there is in the future. Uncertainty is going to lead to risk. We also want to take into consideration the next best opportunity. If we didn't invest in this truck, what else could we have done with it? So those are some of the factors we'll take a look at as we go through some examples with regard to capital investments.